Welcome guys, this is Alpha Max Partners managed by two CFA charter holders with more than 15 years of investment experience. Our main goal of this YouTube channel is to educate retail investors and to help them in minimizing their trading risks. As soon we got 1,000 subscribers, we are planning to start a 3x portfolio in 3 months using stocks that are trading under $5. So, please subscribe and click on notification bell icon to help us grow fast and gather all rational retail investors at one place. Without any further delay, let's start our today's video to know how to trade in market when you are expecting a stock market bubble. There is a saying that water seeks its own level. What does this mean exactly? It means that, despite short-term fluctuations higher or lower, the markets will eventually determine the proper value of a security. If a stock's proper value is $10 but it is being pumped up by speculators and is currently trading at $25, then you can rest assured that the stock price will eventually trend towards its proper value. This is the same when it comes to the markets as a whole. If speculators and overeager investors are pushing the overall value of a market beyond its proper value, then the market is said to be in a bubble. Think back to the dot-com bubble of 1999 to 2000. The markets became disconnected from reality as the investing public piled into dubious dot-com stocks. Many of these companies were worthless and had nothing in the way of a sustainable business model, but investors didn't care, driving the Nasdaq to over 5,000 points. Were the underlying components of the Nasdaq really deserving of a multi-thousand-point gain in just a short period of time? Of course not. This was a bubble, and eventually everything came crashing down. Water seeks its own level. If we see current Nasdaq chart, obviously you will find it's trading at 14,000 plus points, which is all-time highest points. Now look at here, in last 3 years, it's almost doubles and eventually it will take a correction, but we don't know when it will take correction. Bubbles are driven by human nature, and human nature is impossible to predict in terms of when it's going to turn. Now the question is, what causes bubbles? Usually the culprit is a herd mentality. A person hears that their neighbor is investing in the markets and doing really well, so suddenly they want in too. Before you know it, millions of people are suddenly plunging their money into equities or gold or whatever else is the flavor of the day, and the market reacts accordingly. That's a stock market bubble, and we have seen many during the history of the DJIA, Nasdaq and S&P 500. And we'll see many more. I've studied the South Sea bubble, the Great Depression and the dot-com bubble. This doesn't feel like 1720, 1929 or 1999, but I can't be sure about that. Certainly, there are stocks and sectors that are bubbly right now, but I'm not sure that means the entire stock market is necessarily a house of cards. However, if the Fed keeps rates low for some time like they say, we get a huge stimulus plan, and demand comes back online in a post-vaccine world, I think a bubble is on the table in the coming years. Bubbles are a natural extension of the markets, more of a feature than a bug, so investors have to prepare for them whether we're currently in one or not. There's no magic bullet position that allows investors to stay in the markets and never lose money, but investors can minimize their losses. To do so, investment professionals offer following 5 strategies. Buy an equal weight fund. Develop a barbell portfolio. Buy dividend-growing stocks. Use options-based strategies. Take some profits. The first strategy is buy an equal weight fund. Stock markets such as the S&P 500 are market cap weighted, so big companies like Apple, ticker AAPL, have a greater influence on price than smaller companies. Another way to rank companies is in equal measure, meaning every constituent has the same weighting, regardless of size. Exchange-traded funds such as the Invesco S&P 500 Equal Weight ETF, RSP, measure the performance of the S&P 500's companies in equal weights. Sam Stovall, chief investment strategist at CFRA Research, says during the tech bubble of 2000 to 2002, the S&P 500 equal weight lost less than half of the market cap weighted index. While equal weight investors still lost money at that time, it was significantly less than what a market cap weighted investor experienced. Stovall says investors who are concerned that the market is being narrowly led higher by growth in tech stocks could consider an equal weight investment if they worry that a fall in these stocks could cause a sharp correction similar to 2000 to 2002. Next strategy is develop a barbell portfolio. Investors who buy individual stocks can use what Stovall calls a barbell portfolio, owning both last year's winners and losers. This is a strategy he likes to use at the beginning of the year. Owning last year's performance leaders is akin to letting winning stocks ride, and buying last year's losers is similar to buying low to hopefully sell high. The barbell portfolio contains 10 stocks or sub-industries, each of both the winners and losers, for 20 holdings total. Stovall says, historically, by owning both, this portfolio strategy has outperformed the broader market on both a percentage basis and a frequency basis, meaning the frequency of advances is positive. He says in 2000, the barbell portfolio was up 1.5% versus the S&P 500's loss of 10%. In 2001, the barbell strategy fell 4% and the broader market declined 13%. And in 2002, the barbell portfolio lost 19%, while the S&P 500 fell 23.4%. For a 2021 barbell portfolio, a few of the best performing sub-industries of 2020 included agricultural and farm equipment, air freight and semiconductors. The worst performing sub-industries in 2020 included airlines, utilities and travel. Third strategy is buy dividend-growing stocks. Look for companies that have a good track record of raising dividends, Stovall says. These companies are known as dividend aristocrats. S&P 500 companies that have paid and increased their base dividends annually for at least 25 straight years. Stovall says dividend aristocrats that offer a yield of more than 2.5% and come with a strong buy recommendation by CFRA analysts include General Dynamics Corporation, GD, Genuine Parts Company, GPC, and Cardinal Health, CA. This is an idea to where you can buy a handful of stocks and sort of set it and forget it, he says. Hopefully, they'll continue to pay or increase their dividends in the future the way they have in the last straight 25 years. A few ETFs incorporate this strategy, although not all of them follow the 25-year rule. Some of these dividend payer ETFs include the ProShares S&P 500 Dividend Aristocrats ETF, NOBL, the ProShares S&P Technology Dividend Aristocrats ETF, TDV, and the SPDR S&P Dividend ETF, SDY. Fourth strategy is use options-based strategies. Burkett St. Laurent suggests a few simple defensive options strategies. Stock options give investors the right, but not the obligation, to buy or sell a security at a given price. Investors who are worried about another market downdraft, such as what occurred in February and March 2020, can buy puts, which gives the buyer the right to sell a security at a certain strike price on or before the expiration date. Buying puts is like insurance, he says, since it has an expiration date. If you're worried the market will pull back in the short term, you can buy a put, which will protect you. For example, if the SPDR S&P 500 ETF Trust (SPY) is trading around $370, an investor who thinks prices will fall can buy a put option trading at the $360 strike price. If the option costs $10 and the ETF falls to less than $350, the put will increase in value because the underlying ETF price is falling. If the ETF price rises, the put expires worthless. Fifth strategy is take some profits. Mike Zigmont, head of trading and research at Harvest Volatility Management, says nervous investors can sell some of their holdings. If something in your gut feels uncomfortable, the best thing you can do is just sell a little bit, he says. That said, don't exit the market completely. All or none decisions are just recipes for disaster, he says. Take a little bit of action if something is making you feel nervous. If stocks make investors nervous, he says to sell perhaps 5% or 10% of a position and put it in something with short-term safety, such as a US Treasury bill or a municipal bond fund. And ignore the naysayers. Respect that feeling and don't let anyone tell you that you shouldn't feel the way you feel, he says. Hope this video will help you to earn profits without thinking too much about market bubbles. If you like this video, please subscribe this channel to receive weekly analysis of stocks to know buy or sell points before everyone new. Thank you for watching.